and welcome along to the Property Academy podcast by Opus Partners. I'm your host, Steve McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking about the 3 changes that are going to make it easier for you to get a mortgage. And these are surprising and kind of obvious for some of them. One of the big things that are coming up are those tax cuts, Andrew. And a lot of people don't realize that those actually make it slightly easier for you to be able to get a mortgage as well. What are you seeing?
Well, yeah, because if you get more money, obviously that makes it easier from an affordability standpoint. If you've got more income, then the banks are going to approve more lending. So the $3.7 billion, I think it was, $3.7 billion? Something like that, with a tax cut, equate to about $20 a week extra pay in your pay packet every week. Now, if it's you and your partner borrowing to buy a property together, that's an extra $40. That's going to work out to be about another $30,000 a year.
It's about $32,000 a year for a couple wanting to invest in property. For first-home buyers, it's about an extra $22,000 a year. Now, it's pretty small. Some people say, oh, well, that's not much, but it could help some people get over the line at the margin. So let's say you're a young couple trying to buy in Auckland at the moment. The average kind of first-home buyer mortgage might be around that kind of $650,000 mark. Well, if you've got an extra 20 grand to spend, that could help you just get over the line. It's not going to help everybody, but it'll certainly help some people. And I think it's one of those things that a lot of people haven't actually thought about and realized that, oh yeah, if we get an extra $40 a week as a couple, that's about an extra $170 a month that the bank is going to look at and then say, yep, okay, you can afford to borrow a bit more money. And hey, while we're on it, we had a really good question from a listener of the show who said, Ed, if I pay off an extra $1,000 of debt on my own home mortgage, how much more am I able to borrow to go and buy an investment property? Now, some mortgage advisors would say, well, debt is debt. So if you pay $1,000 off your own home, then you get another $1,000 to go and buy an investment property. But it's actually not quite that simple, is it?
Yeah, no, with your personal home, obviously there's no rental income. So you pay your $1,000 off, that reduces your personal lending. But if you're going and buying an investment property, there's obviously rental income that comes into the servicing equation as well, or the affordability equation as well. So it works out that if you pay off $1,000 off your own home, you can borrow actually around $2,300 for an investment property once you factor in that additional rental income you're going to receive.
Yeah, the other thing that you need to think about, and I've actually got a spreadsheet for this, let's just pull it up, is you've also got to think about the term, which is how fast you're paying off that mortgage. So for example, let's say you're paying off your own home mortgage over 10 years, you've got 10 years left to pay it off. Well, if you pay off an extra $1,000 of debt, when you go and buy an investment property, not only do you get some rental income, so you can borrow more, but you also might say, actually, Mr. Banker or Mrs. Banker, I'm going to pay that debt on my investment property off over 25 or 30 years. Because you're paying it off over a longer term, you're then able to borrow more money. And actually, it starts to add up depending on like how fast you're paying it off. So let's say you pay an extra $1,000 off your mortgage and you're currently paying that mortgage off over a 10-year period. Then we can run a little calculation, Andrew.
We goal seek.
We goal seek. If anybody doesn't know about goal seek, you should really, it's just the God's gift to Ed McKnight. Yeah, you get about that $2,300 extra that you're then able to borrow for that investment property. So depending on how your loan is structured, paying off $1,000 extra against your home might mean that you double the amount you can borrow for an investment property. You just want to talk to a mortgage advisor to actually run those numbers for you.
Now, one thing, when I was looking at your spreadsheet, you've got a servicing test rate of 9%. So that might cover that at the moment as well, because right now, if you go and take a mortgage out with the bank, you might pay 7% on your interest rate, right? But they're going to assess your loan based on a higher interest rate. We call that a servicing test rate, to make sure that you can tolerate changes to the interest rates.
And so effectively what that means is they don't want to give you a loan. Then the interest rate goes up and they have to sell the property from under you.
Because you can't afford it.
At a mortgagee sale.
Yep.
So even though you're going to pay a 7% interest rate, they're going to run their numbers as if you're paying a 9% interest rate.
Yeah. And what's going to happen with interest rates going down is the servicing test rate will come down as well. So let's say interest rates got to 4.5% again or something like that, or 5%, right? It would be probably pretty unfair to use a 9% servicing test rate at that stage because they're wildly apart. The banks want there to be a bit of forgiveness in that servicing test rate, but they don't want it to be extreme. So maybe it might be 7% for the servicing test rate.
And it actually impacts you quite a lot in terms of what you are then able to borrow. And I actually ran these numbers. So at the moment, as I said, the servicing test rate is about 9%. So let's say that you are able to afford a mortgage currently of 620 grand for an investment property. And that's what the bank's going to lend you. If that interest rate, that servicing test rate, went down to, let's call it 8%, now you can borrow 750 grand. So an extra 130K. If it falls down to 7%, now you're able to borrow about 915 grand. So what's that? Oh my God, math's terrible. About an extra $165,000 as well. And so if you are unable to afford a mortgage at the moment, or you're not able to borrow enough to go and buy the investment property you want, as those servicing test rates come down, you might find that it is substantially easier to go and get lending.
And so if you're an owner-occupier, you got the average mortgage, what is it, $309,000, and you want to go out and buy a rental property. Right now, if you can borrow, say, $620,000 based on your current income, when servicing test rates drop to a more normal level, what, 7.5%, that 620 that you can borrow increases quite drastically to about 860 grand.
And it's important to mention, Andrew, that the servicing test rates have not dropped yet, right?
No.
So most banks are still testing around 9%. So it's not like it's just automatically become much, much easier, but it is going to move in that direction. So just stay engaged with the property market.
Now, just bear in mind, as they come down, all of a sudden those debt-to-income ratio rules are going to kick in and affect some people as well. So it might be that, okay, now all of a sudden you pass the servicing test rate, or you pass the servicing calculations, but you no longer meet the debt-to-income ratio rules.
Yeah, and just to simplify that for any new listeners of the show, there are kind of three tests that the banks will usually look at, especially these days. They're looking at, do you have enough deposit? Do you have enough income to afford the mortgage? And what's your debt-to-income ratio? How much debt do you have compared to your income? And when they run those three tests, you are only able to get a mortgage of the minimum of those three different tests. So if it becomes a lot easier to borrow from what we call a UMI or affordability perspective, you could afford the loan, then that DTI, the debt to income, might start to limit you a bit more. Now, have we talked about Westpac yet?
No.
So talk to us about Westpac.
Yeah, now Westpac are the first bank, first cab off the rank to make some changes around the triple CFA, so the way that they're assessing your affordability based on your expenses. Now, previously, Westpac was looking at your rent minus 25%, so they take a discount off that to allow for costs, right? And then what they would do is they deduct your rates, your insurance, your body corporate, your residents association, any of those fixed costs.
And actually, if we were just to build a little spreadsheet for you and I right here for ourselves, so effectively what Westpac would do is, if your rent was, what's the rent on a property?
Say $700 a week.
$700 a week, then they'd say, minus 25% for costs, or what is often known as the servicing haircut. Is that just what we call it?
You've just come up with that, and I noticed that you're just calling that. You're just calling it that all the time
what do
now.
the banks call it?
I don't know.
Okay, so after that,
banks are probably calling it that now as well.
So instead of looking at $700 a week, they are only going to include $525 a week of your rent in terms of when it comes to actually paying the mortgage and their calculations. But then if you've got rates, insurance, body corp, what's that?
Let's call that $5,000 for all of those. So another $100 a week coming off that.
So your annual rent is about $36,500. But when it comes to how much of that rent is used in the bank's calculations to cover your mortgage, they're actually they only used to allow you to use about 22 grand of that, which is about 60% of that actual rent.
Yeah, it's a big discount, isn't it? So they're going to take 40% essentially off the top, and then they're going to apply a higher servicing test rate than you're actually going to pay.
Now, the big difference here is with Westpac removing and saying, we're actually not going to consider your body corp, your rates, your insurance in our calculations. That means that you've got an extra $100 a week in the bank's eyes to actually pay for your mortgage. Because it looks like you've now got more money to afford more mortgage, you can now afford to borrow more. Now, how much of a difference does this actually make?
So it works out for the average property investor about another $80,000 worth of borrowing power.
But it's actually 80 grand per property you own.
Yeah, which if you're a portfolio investor and you've already got 5 investment properties, that could be up to $80,000 per property that you can borrow extra, plus any additional properties that you buy.
Yeah. Now, it is important to say that Westpac was particularly punitive in the past with these kind of calculations. In the past, they were actually one of the only banks using this specific method of calculating how much you can afford to borrow for a mortgage. So this now puts them more in line with the other banks. But this is kind of the first change of many that we expect to see over the next couple of years. And so if we think forward about what's going to happen over the next 3 years, what do we see? First of all, we've got the tax cuts that by the time this video and podcast gets released, they'll be phased in. That gives you a little boost to the amount you can borrow. Then on top of that, we're going to have triple CFA changes. We're already seeing Westpac bring those in. That's making it easier to borrow. And then we're going to see the servicing test rates decline over the next couple of years. And that is going to make it even easier for people to borrow as well. And so once you add it all up, the key message is if you can't afford to buy your next investment property right now, perhaps you can in a year's time. Right, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you're listening to this on Spotify or Apple Podcasts, you want to see our faces along with our spreadsheets, just Google Opus Partners YouTube. It'll be the first thing that comes up. If you're watching on YouTube, make sure you hit the subscribe button. We release new videos every Monday and Wednesday. Thanks for listening to the Property Academy podcast. I'm your host, Stephen Knight.
I'm Andrew Nicol.
We're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you be the most out of this property market. Until next time.